And it is not an accident, again, that gold is at a new record high. And while people were dumping shares of Newmont Mining this morning and Barrick Gold and Kinross and all these stocks, gold prices were going up. Right? Even though gold initially was down $20, it rallied, $35 from there. Why? Who was buying? Well, who do you think, right? The same guys that were at the BRIC conference, because again, they're not buying the mining stocks, they're buying actual gold. That's what they need. They're not making an investment. They are replacing US dollars with a superior monetary instrument that they can hold in reserve. And in fact, a lot of these countries, China in particular, are encouraging their citizens to go out and buy gold, buy silver. Right? Our government doesn't encourage anybody to do that. We try to prevent you from doing that. So this is going to continue. People out there, some of these people are going to be at the New Orleans conference. George Gammon, Brent Johnson, they'll be there at this New Orleans conference. But they're on the opposite side of me, at least in the short run, when it comes to the dollar. Right? I mean, I'm out there saying the dollar is going to crash, and they're saying no, the dollar is going to surge. The dollar is going way up, and then it's going to crash. So they kind of agree with me that eventually the dollar crashes, but they just think it's going to have a huge rally before it does. And I think it's already had a huge rally. I don't know that rally is going to get any bigger. I mean, we have had a big rally in the dollar since the lows of 2008. The dollar index was down around 71, and now it's 104, and it did get higher than that, but that is a rally. Now, obviously, they think, well, the rally could be much bigger, and their thesis seems to boil down to the fact that there's so much dollar debt, and because so many countries have to repay dollar debt, that there's going to be this demand for dollars, because I owe dollars, so I need dollars to pay my debt. And the fact that these companies around the world that owe dollars, need dollars, is going to put all this upward pressure on the price of the dollar. And maybe if you just look at it superficially, all these countries have borrowed dollars, they have to pay back their debt, and then if they default on their debt, the people who were owed those dollars aren't going to get them, right? So dollars are going to disappear because companies are going to go broke because they can't afford to repay their dollar debt. And so all this is supposedly going to be bullish for the dollar. And I don't buy into that. First of all, that was true. Companies had a lot of dollar debt from 2001 to 2008, when the dollar index went from 120 down to 70. I mean, that was one of the worst bear markets that we've seen in the dollar. That was an all-time record low for the dollar index. I remember the dollar got down, to just 80 Japanese yen. It's, doubled since then, although it's pulled back from that high. But so the dollar was able to fall in that environment. And, the world still had a lot of dollar debt back then. In fact, the dollar was a bigger part of the global economy, as far as a percentage of reserves or trade than it is now. So it still happened. I think the people that are missing is that just because I owe dollars, I owe dollars to another foreign entity. So let's say, you're a Polish company that owes a German company dollars, right? You just did a deal in dollars, right? You didn't do it in zloty, you didn't do it in euros, you did it in dollars. So there's dollar debt on the books of this company. Well, when the Polish company repays its dollar debt, what is the German company going to do with the dollars? Well, it's going to sell the dollars to get euros so it can pay its expenses, pay workers, rent, dividends, whatever. So just because a debt is owed in dollars doesn't mean it's staying in dollars. So yes, there's demand for dollars to repay dollar loans, but then when people get repaid those loans, they sell those dollars, right? It's not like they're just going to hoard them, especially if the dollar is going down, right? If the dollar is falling and somebody is repaying you dollars, you might want to get rid of them as quickly as you can.
Watch this video till the end. Peter Schiff gives shocking news to you. Also like this video and subscribe to our channel for the best updates. Let's discuss the differing perspectives that are making waves in investment circles. On one side, notable experts like George Gammon and Brent Johnson predict a massive surge in the US dollar before an eventual crash. On the other, you have Peter Schiff and others who argue that the dollar has already experienced its rally and is now on the brink of a significant decline. The question arises, who is right? Are we looking at a dollar surge before the crash, or has the time already come for the greenback to take a nosedive? To understand this debate, it's essential to look at the dollar's journey since the 2008 financial crisis. The dollar index, which was languishing around 71 during those challenging times, climbed to approximately 104, even hitting higher points along the way. This substantial run raised hopes among proponents of a strong dollar. However, skeptics argue that this might be the end of the line for dollar strength, not the beginning of another rally. They point out that while the massive global dollar-denominated debt could create an insatiable demand for dollars, this demand might be temporary. Once debts are paid, the need to hold on to dollars diminishes, potentially leading to a decline in its value. Historical context supports this skepticism. From 2001 to 2008, despite the world being heavily indebted in dollars, the dollar index plummeted from 120 to 70. This period demonstrated that high dollar-denominated debt does not necessarily prevent a steep decline in the currency's value. Additionally, the global financial system is evolving, with the dollar losing its grip as nations seek to diversify their reserves. Enter the BRICS nations: Brazil, Russia, India, China, and South Africa, who are leading efforts to reduce reliance on the US dollar. They are exploring alternatives like using their own currencies or even gold for international trade, aiming to build a more resilient and independent financial infrastructure. Moreover, technological advancements and the rise of digital currencies are further challenging the dollar's dominance. Cryptocurrencies like Bitcoin and Ethereum offer decentralized alternatives that are gaining traction among investors and even some governments. These digital assets provide a hedge against traditional financial systems and offer greater transparency and security, which could diminish the dollar's role in global trade over time. In this shifting landscape, gold remains a steadfast alternative. Its universal value and independence from any single government make it an attractive option for countries looking to stabilize their economies. If BRICS nations continue to move away from the dollar and adopt gold-backed or digital currencies, the demand for gold could see a significant boost, reinforcing its position as a critical asset in the global financial system. As we navigate these critical financial shifts, it's important to stay informed and consider diverse perspectives to make strategic investment decisions. Whether the dollar is poised for one last surge or is set to decline sharply, understanding these dynamics can help investors protect and grow their wealth effectively. If you found this analysis insightful, make sure to like this video, subscribe to our channel, and hit the notification bell to stay updated on the latest financial trends and investment strategies. Share your thoughts in the comments below. What do you believe is the future of the US dollar and precious metals like gold and silver? For those looking at the global economy's long-term trajectory, it's essential to keep an eye on the dynamics within the BRICS nations. Their growing economic influence and collaborative efforts to reduce dependence on the US dollar are more than just headlines. They represent a possible reconfiguration of international trade and finance. The shift away from dollar-backed transactions could indeed spark a larger demand for gold, especially if these nations begin to back their currencies with physical assets like precious metals. Gold, with its historical resilience, provides an asset that can serve as a hedge against inflation and currency devaluation, making it an appealing store of value. Imagine the impact if major economies start using gold or other alternatives like digital currencies in trade. Such a move would introduce a level of independence for these countries, allowing them to bypass the volatility of dollar-denominated trade and create a more stable foundation for their economies. The implications for the US dollar could be profound. A reduction in global reliance on the dollar could weaken its position as the primary reserve currency, especially as countries like China and Russia advocate for a multi-currency world. In this scenario, we may see a gradual but substantial rebalancing of economic power.
If China and Russia want to do business together, or companies, right? The idea is for the buys or sells to either be in RMB or rupee, right? Not in US dollars. Now, because why? I mean, first of all, it makes no sense. Why should two countries that don't use dollars transact in the dollar? Just pick one of the currencies that's involved, right? You got two countries that have currencies. Why involve the United States, a third party who's not even involved in the transaction? Why use our dollars? Use the currencies that you're actually transacting in. And so that is the goal, right? For the BRIC nations to just phase out the use of the US dollar and use their own currencies. Now, maybe one day they will come up with a new currency, I think they should just use gold. I mean, to me, it makes the most sense for international trade to be conducted in gold. That's fair. That's arbitrary. You're not just picking some other, currency, because everybody uses gold. Gold is valuable everywhere, right? Everybody knows the value of gold. Gold is used in every country. And so you could use that. You don't have to reinvent the wheel and come up with a new currency. You got money. Just transact in real money. That's already there, right? You don't have to create it. You don't have to invent it. It exists. It's been here for thousands of years, right? That's what that they should use. And in fact, if these countries decided to go back on a gold standard where their currencies were all pegged to gold at a specific rate, and they kept that, then there wouldn't even be any foreign exchange risk. If the ruble is tied to gold and the rupee is tied to gold, or the zloty or the South African rand, if they're all fixed to gold, then their exchange rates aren't going to fluctuate. And so it would make it very easy to trade. Now, of course, if a government, somehow became reckless and irresponsible, and ultimately they might have to devalue. But if once you get back on a gold standard, you're much more likely to act fiscally responsible, so you don't have to devalue, so you can maintain the relationship that you've established. But in the meantime, what's going to happen is that the dollar is going to be reduced in the transactions. That's the goal. They want to move away from the dollar. And of course, if they're moving away from the dollar in transactions, well, they're also moving away from the dollar as a reserve asset. Right? If you're not going to use the dollar as much, if you already recognize the vulnerability, they talked about at the BRIC conference, the political risk and the sanctions and all that. And that's another reason for them to step away from the dollar. So this is going to happen. And it is not an accident, again, that gold is at a new record high. And while people were dumping shares in Newmont Mining this morning and Barrick Gold and Kinross and all these stocks, gold prices were going up. Even though gold initially was down $20, it rallied, $35 from there. Why? Who was buying? Well, who do you think, right? The same guys that were at the BRIC conference, because again, they're not buying the mining stocks. They're buying actual gold. That's what they need. They're not making an investment. They are replacing US dollars with a superior monetary instrument that they can hold in reserve. And in fact, a lot of these countries, China in particular, are encouraging their citizens to go out and buy gold, buy silver, right? Our government doesn't encourage anybody to do that. We try to prevent you from doing that. So this is going to continue.
A curious development that underscores this potential retail awakening is Costco's decision to start selling gold. Yes, Costco, the same place where you buy bulk toilet paper and giant tubs of peanut butter, is now a gold retailer. And guess what? They can't keep it in stock. It's flying off the shelves. This signals a broader shift in public awareness. People who never considered buying gold are now seeing it as a viable option. If this trend continues and spreads to other major retailers, we could witness a new wave of gold buying that drives prices to unimaginable levels. We can't talk about gold without mentioning silver. Silver often lags behind gold in a bull market, but when it catches up, it does so with a vengeance. Historically, silver has seen explosive moves once gold establishes a clear upward trend. And silver isn't just a precious metal. It's also an industrial metal, with applications in technology, renewable energy, and even medicine. The demand for silver is only going to grow, yet its price remains significantly undervalued. Central banks don't typically buy silver, but if rumors are to be believed, that could change. There are whispers that Russia and India are considering adding silver to their reserves. If that happens, we could see a seismic shift in the silver market. The price of silver, currently languishing in the $30 range, could skyrocket, especially if it breaks through key resistance levels. One of the most monumental shifts occurring right now is the global move away from the US dollar. The BRICS nations, along with a growing list of countries, are no longer content to be at the mercy of US financial policies. Sanctions against Russia have accelerated this process, as nations around the world have seen just how vulnerable they are if they continue to rely on the dollar-dominated global financial system. Russia, for example, has not only weathered the storm of Western sanctions, but has emerged stronger in some respects, largely due to its strategic accumulation of gold. The Russian ruble didn't collapse as many expected, and the Russian economy didn't implode. Instead, we're witnessing an extraordinary show of resilience. This resilience is rooted in their tangible, hard asset strategy, particularly their massive stockpiling of gold. It's not just Russia. China has been playing the long game too. For years, China has been quietly and systematically increasing its gold reserves, while at the same time encouraging its citizens to do the same. This isn't just about hedging against inflation or preparing for economic turmoil. It's a clear and calculated move to insulate themselves from the dominance of the US dollar. Imagine a scenario where several major economies back their currencies with gold. It might sound like a fantasy, but it's becoming increasingly plausible. As we discussed earlier, gold is a universal standard that doesn't rely on the policies or stability of any one government. A gold-backed currency would immediately have credibility and value in a way that no fiat currency can match. Consider this. If BRICS nations decided to link their currencies to gold, it would fundamentally alter the global economic landscape. Trade agreements between these nations could be settled in gold-backed currencies, bypassing the need for US dollars entirely. This could severely weaken the dollar's influence not just in trade, but also as the world's reserve currency. And let's be honest, the US isn't helping its case. The Federal Reserve's loose monetary policies, enormous fiscal deficits, and rampant money printing have all contributed to a growing distrust in the dollar. Inflation is still a significant issue, and as the US continues to rack up debt, other countries are understandably looking for alternatives. If we're heading toward a world where gold plays a central role in international finance, then the price of gold is likely to go much higher, and not just incrementally higher. Think orders of magnitude higher. In Part 1, we touched on the idea that gold could be revalued significantly, perhaps even to $10,000 or $15,000 an ounce, if it were to become the linchpin of a new global monetary system. Now, this might sound extreme, but consider the mechanics of such a move. If countries were to back their currencies with gold, they would need to ensure that the value of gold relative to their national debts and economic output was appropriate. The only way to do that is to revalue gold to much higher levels. Historically, this isn't without precedent. We saw something similar when Franklin D. Roosevelt revalued gold in 1933, significantly increasing its price to help the government manage its financial obligations. If such a revaluation were to occur today, it wouldn't just be a minor adjustment. It would be a seismic event that would send shockwaves through global markets. Gold would become the ultimate safe haven asset, and the demand for it would be unlike anything we've seen before. Now let's pivot back to silver, the often overlooked sibling of gold. Silver is unique because it's not just a precious metal. It's also an industrial metal. Its applications in technology, renewable energy, and medicine make it incredibly valuable. Yet despite its importance, silver remains drastically undervalued. The gold-to-silver ratio is currently much higher than historical norms, indicating that silver is incredibly cheap relative to gold. Historically, silver tends to outperform gold during bull markets. We've seen this pattern play out repeatedly. For instance, in the bull market of the late 1970s, the silver price skyrocketed from around $1.50 to nearly $50 an ounce. More recently, during the 2010 to 2011 run, silver went from under $10 to almost $50. If gold is set to soar, silver could easily follow suit, and its percentage gains could be even more spectacular. Some analysts believe that silver could hit $100 or even $200 an ounce in a future bull market. Given the current price of silver, that represents a tremendous upside. Let's not forget the massive short positions in the silver market held primarily by a few large commercial banks. These entities have been shorting silver for years, creating a paper market that far exceeds the amount of physical silver available. If there were ever a run on physical silver, if investors demanded actual delivery rather than settling in cash, it could trigger a short squeeze of epic proportions. Imagine what would happen if one of these big banks decided to exit its short positions, or if a major player like a foreign central bank started buying up physical silver. The price could spike dramatically and those short positions would become untenable, forcing a wave of buying that would send silver prices through the roof. This isn't just idle speculation. We've seen glimpses of this potential before, and given the current dynamics in the market, the risk of a short squeeze is very real. When it happens, it will be a rapid, chaotic event, and those who are positioned in silver will stand to benefit immensely. You might be wondering, if silver has so much potential, why aren't central banks hoarding it like they are with gold? The answer lies in tradition and utility. Central banks have historically held gold as a reserve asset, and it's universally recognized as a form of wealth preservation. Silver, while valuable, hasn't played the same role in modern central banking. However, this could change. There are already rumors that some central banks, particularly in Russia and India, are considering adding silver to their reserves. If this happens, it would be a game changer for the silver market. The demand from a single central bank could absorb a significant portion of the annual silver supply, pushing prices higher. As we discuss the implications of all these international moves, we have to come back to the elephant in the room: U.S. fiscal policy and the Federal Reserve. The U.S. government is running massive deficits, and the Fed has been forced to monetize this debt through bond purchases. Even as they talk about reducing their balance sheet or raising interest rates, the reality is that they're stuck. They can't let interest rates rise too much without crashing the economy, but they can't keep them artificially low without fueling more inflation. It's a classic lose-lose situation, and it's why many investors are turning to gold and silver. These metals aren't just hedges against inflation, they're insurance policies against the collapse of fiat currencies. As more people realize the precariousness of the current system, demand for gold and silver will only grow.